Welcome to a State Bank of India special as the Grand Old Bank celebrates its 70th birthday today. SBI is, of course, mini Indian economy, accounting for 20% of the country's bank credit, 22% of the country's bank deposits. 55 years ago, SBI was born when the Imperial Bank was converted into State Bank of India under the SBI Act. Since then, its deposits have grown, hold your breath, 25,500 times. Its profits in the latest year at 77,561 crores was 52,000 times what it was in 1955. When the nation is in trouble, it looks to SBI. At the height of the balance of payments crisis in 1991, SBI raised $1.6 billion through the India Development Bonds, and it repeated this feat again after a decade during the Pokhran nuclear test in 1998 when India faced sanctions. SBI personnel go on to head many other banks, Yes Bank included, and also staff the RBI and the SBI. You know, there is a deputy governor over there. Most important, SBI has changed with the times. In its 50th year, the bank gave its younger competitor HDFC solid competition in home loans and actually won that competition. Today, with its YONO, it is competing with even fintechs. And on that celebratory note, may I welcome the birthday boy of the day, SBI Chairman, Mr. Challa Srinivasulu Setty. Mr. Setty, thank you very much for dropping into our studio on what must be a big day back home at SBI.
Thank you, Lata. It's a great moment for all of us. And I wanted to be in your studio to celebrate this occasion.
We are honored. We are honored.
And, I think the journey of SBI is also synonymous with the journey of India. I think to that extent, it's a great moment to celebrate.
Absolutely, sir.
Thank you.
Actually, when SBI comes, one looks at the future. And so will our viewers. So just give us an idea. What are the immediate targets you have set the bank?
I don't call them targets, but we believe that if you have seen the journey of SBI, it always reimagined its role and stayed relevant.
Yes.
So we believe in SBI that going forward, while we have seen a lot of disruptions in the last 70 years, the disruptions will be much more frequent and much more deeper. So how do you handle these disruptions coming in, particularly in terms of your business models, in terms of the service delivery, in terms of customer protection? I think we all want to focus making SBI ready for another maybe 200 years. Okay. This is what. So the center to this plan is our digital transformation journey. While we have, as you mentioned, the scale, and we have the trust of the people, but the scale and trust alone will not make you the best and most preferred bank.
Yes.
So we would like to assure our customers and stakeholders that our investment in technology, digitalization will continue so that the customer engagement with us, which will be much more seamless.
Okay. Well, actually, would you say that in the journey, in the 75 years, the government and the regulators' attitude to SBI and state-owned banks has changed? I mean, first, PSU banks, after nationalization, were part of the fisc. There was financial repression. But in 1991, you all were listed. SBI was listed first. And after that, more recently, I mean, the CRR cut, there is no big danger in front of the country. Still, the CRR cut is given so that I think banks have a fair chance against mutual funds. Would you say the attitude is changing to give you all a fair chance?
See, the public sector banks are having a dominant market share.
Yes.
Some of them would have lost the market share, but I think they're all trying to...
Collectively, 60%.
Collectively, we are the dominant players in the industry, which means that any initiative, either by the government of India or by the regulator, cannot be meaningfully taken to the economy and the general public unless there is a wider participation of the public sector banks. I don't think there is any shift in the attitude. But one thing I can definitely tell you that maybe for the last 2-3 decades, or definitely in the current decade, is that we are getting a absolutely commercial banking approach within the public sector banks, and what I call ownership neutral approach towards serving the customers, and that is getting reflected. Obviously, the CRR cut is not meant for only.
You're getting a level playing field.
Absolutely.
Okay.
Absolutely.
That has been the tone of the Reserve Bank, but I think the banking sector, that is public sector and private sector, have got a better deal this year with liquidity being thrown in and the CRR cut. How are you looking at this combo affecting your credit growth? I believe the finance minister also met you all. Do you think this year the credit growth will be much better? Last year, I think we are finishing at 9-10%, FY25. What is your sense of this? Since
our silent period started now, I can't...
I'm asking you about the sector.
We can't talk only about SBI, but I think in general, what are the preconditions for any economic growth? I think those things are being ensured fairly well in terms of ensuring that the system liquidity is adequate, and as you mentioned, CRR cut will add further liquidity to the system. Apart from the benefit of protecting the margins, which cost of funds are reduced, the other thing is that the upfronting the rate cut. These are all indications, signaling obviously is towards ensuring that the growth is on the higher pedal. I think this is
higher priority.
Higher priority, and the Government of India's initiative of putting some extra money in the hands of the people to encourage the consumption by reducing the rate of taxation.
You give me numbers for the banking sector, sir. I know I don't want to corner you on your silent period issue.
The banks will definitely come back to the credit growth.
So you think we could do 13, 14? I don't know how well you remember the 2002 to 2004 period. Reserve Bank had cut rates from 15 to 8%. After the Pokhran, we had to raise our rates, and then Asian crisis, we brought it down dramatically. But credit growth didn't pick up for another 2 years. It remained at 10%. And then only in 2005, we see this 25% jump in credit. When it slows, takes time to grow.
Absolutely.
But now do you think it can be faster?
I think it is. Stage is set in my view, maybe a couple of quarters from here. One is the corporate credit has been a challenge for the last few quarters. It is mainly because they're all sitting on a
retained profit,
reasonable cash flow, cash availability to them. And I believe that a lot of brownfield expansion, which is undertaken by them, is being taken by their own cash. And that is also getting reflected. If you see the SME growth, we are all witnessing good growth in SME, which means that SMEs are basically B2B businesses, right? If the corporates are not giving the orders, they're not going to perform better. So which shows that the corporates are spending and also giving the orders to SMEs. But the next inflection point for the capital expenditure would have to come. One is most of them are operating at 75 to 76% capacity utilization. And a sustained consumer sentiment and consumption growth. It is not that it's not there, but I think people would like to see the sustained level of that.
You're saying that capex has not picked up, but it is looking all set to pick up.
All set to.
Okay. What's your sense about margins? Again, for the sector, I'm not cornering you, because you're going to get this, the rate cut will take away your margins, but the CRR cut will give you back margins, and it comes with a multiplier. Yeah. Every subsequent deposit will give you some gain. So will you come back to your FY25 margins in 4 quarters, 6, or for the banking sector? Does it take 4, 6 quarters to come back?
Most of the banks have indicated that it will be a kind of U curve for the NIMs that you will have. I mean, there is no rocket science in that. There's a lag of deposits getting repriced, whereas...
How much? Is it 2 quarters lag, 4 quarters?
No, I think we'll have to look at Q4 end state.
Okay.
And most of us probably would be sticking to our margins at the Q4 end state. That is what I can tell you now.